Listen to me, because what I'm about to tell you is the difference between a retirement of security and a retirement of absolute regret. You've worked 40 years. You've saved. You've sacrificed. You've put your money into your 401(k)s and your IRAs, and you've watched that money grow tax-deferred. You thought you were in control, didn't you? You thought that money was yours to do with as you pleased, whenever you pleased. But here is the wake-up call. Uncle Sam has been a silent partner in your retirement account since the day you opened it, and he is tired of waiting for his cut. What is an RMD? It stands for Required Minimum Distribution. But if you want to know what it really is, it is the IRS coming to your door and saying, hand it over. They let you grow that money without paying a cent in taxes for decades, but they aren't going to let you leave it in there forever. They want their tax money, and they have passed laws to make sure they get it. Now, I know what you're thinking. Susie, it's my money. Why can't I just leave it there for my kids? Because the law says you can't. And if you don't understand the rules, especially with the new Secure Act 2.0 changes, you are going to be hit with one of the most vicious penalties in the entire tax code. We are talking about a 25% penalty on the money you were supposed to take out but didn't. Think about that. If your RMD was $20,000 and you forgot to take it, the IRS is going to take $5,000 right off the top as a penalty, and then, get this, you still owe the ordinary income tax on that withdrawal. You could lose nearly half of your distribution to the government just because you weren't paying attention. Is that what you want? Is that why you worked so hard? No! So let's get real. When does this start? For most of you watching this right now in 2026, the magic number is 73. If you were born between 1951 and 1959, 73 is your age. If you were born in 1960 or later, they've pushed it back to 75. But don't let that pushback make you lazy. Time moves faster than you think. You have until December 31st of every year to take that money out. There is one, and only one, little break they give you. In the very first year you hit that age, the IRS says you can wait until April 1st of the following year to take your first distribution. But I am telling you right now, do not do it. Why? Because if you wait until April to take your first one, you still have to take your second one by December of that same year. You will be doubling up your taxable income in a single year, which could push you into a higher tax bracket, increase your Medicare premiums, and make your Social Security taxable. You are walking into a tax trap. How do you even know how much to take? It isn't a guess. The IRS has a table, the Uniform Lifetime Table. They take your account balance as of December 31st of the prior year, and they divide it by a life expectancy factor based on your age. Every year you get older, that factor gets smaller, which means the percentage you must take out gets bigger. It is a math equation designed to empty your account by the time you pass away. I want you to feel the weight of this. This isn't just extra money to spend. For many of you, this RMD is going to feel like a burden because you might not need the money to live on. But you have to take it anyway. So what do you do if you don't need it? You don't just let it sit in a checking account earning nothing. You move it. You take the distribution, you pay the tax, and then you put that money into a high-yield savings account or a taxable brokerage account where it can keep working for you. Or, if you are charitably inclined and you're over 70 and a half, listen closely, use a QCD, a Qualified Charitable Distribution. You can send your RMD money directly to a 501(c)(3) charity. It satisfies your RMD requirement, and the best part? It doesn't count as taxable income to you. That is a power move. That is how you keep your money out of the hands of the IRS and put it where it can do some good. The fear I see in so many of your eyes is the fear of outliving your money. And RMDs feel like the government is forcing you to run through your savings faster than you want to. I understand that fear. It is a valid fear. But the solution isn't to ignore the rules. The solution is to have a plan. Here is your actionable takeaway, and I want you to do this today. Not tomorrow, not next week, today. First, go to your financial institution's website or call your advisor. Ask them, what is my RMD amount for this year? Don't calculate it yourself on a napkin. Get the official number. Second, set up an automatic distribution. Do not trust your memory. Set it to go out in October or November so you aren't scrambling in the last week of December when the banks are closed. Third, look at your tax bracket. If this RMD is going to push you over the edge, talk to a tax professional about those qualified charitable distributions I mentioned. You have the power to control your financial destiny, but only if you have the courage to face the numbers. Don't let a required distribution become a regretted mistake. You are a person of worth. Your money is a tool for your freedom. Use it wisely, follow the rules, and stand in your truth.